Hello everyone and welcome to my channel. In this video, we're going to talk about one of the most intriguing tech companies that has been traded on the Nasdaq, Nikola Motor. It has been one of the rising stars of the 2020 era when the EV seemed to be on the verge of taking over the world. Of course, that was not how things have eventually played out, and today people are left wondering whether there is any possibility for Nikola to cover its former glories. In today's video, we're going to talk about Nikola, the recent price actions, the technical aspects, and what is the best trading approach given the circumstances. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, Nikola has been struggling to keep its price at and above the $1 price, which is required to maintain its stock to be traded on a Nasdaq exchange, one of the most liquid, prestigious, and also the most prosperous exchanges for the tech and speculative positions. There was a tremendous amount of hope for the stock, but in the past few years, things have drastically changed. The company once pretended that it can rival Tesla to be the next key player in this burgeoning industry, but of course, we now know that whatever hope that we have put in there has gone the other way. From accusations of fraud, the constant changes of management, as well as the myriad of supply chain difficulties have really plagued the stock down and forced it to eventually dilute the shareholders to keep the ship afloat, further exacerbating the existing problem. Doing so affected the stock price of Nikola, and there is little, if any, potential to see if the stock bouncing back from the fundamental perspective is even possible, especially given how the EV market now seems to have a different perspective in terms of its outlook. The only hope at this point is to wait for the decrease of the interest rates and to benefit from an industry-wide or sector-wide jump upward and to trade the volatility. With that being said, let's take a look at the technicals. The trading volume of Nikola has recently been around 78 million shares versus an average volume of 77 million shares. Over the previous 52 weeks period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there is enough liquidity to support a trading strategy. If the flow is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is thin as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be very significantly higher than the average volume. The market cap of Nikola is currently around $704 million. As we compare the current price to the historical price fluctuations, the stock is 5% higher than its 1-month low, 5% higher than its 3-month low, and 5% higher than the 52 weeks low. On the options market, which sometimes gives us a hint on the market sentiment about where the stock price is probably going to go next, the implied volatility here is around 143% versus a historical volatility of 99%. The put-call volume ratio is currently around 246%. It is normal for many stocks to have a higher put option volume than what they truly deserve because many institutional investors hedge their long positions with put options. The most recent volume of options traded is 62,000 contracts within a day versus the 30-day average of 75,000. In terms of open interest, the most recent volume of open interest is around 2.1 million contracts, compared to the 30-day average of 1.7 million contracts. So, in terms of the shareholder structure, Institutional owners hold about 24% of the total float, which is already considerable. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Typically, it's always good to see some institutional participation and presence when holding a stock long term, because it offers a layer of stability and token reliability in the medium to the long term. It means that the market is confident that it's going to deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership. Of course, there are many exceptions to that rule, as there will always be great companies mostly owned by the retail traders. The current short interest is around 20% of the total float, and 54% of which come out from the dark pools. So if the short interest is about 15% and more, and a significant chunk of it comes out of the dark pools, I would say that there's a real possibility for institutional involvement to short the stock simultaneously, thus calling for a potential short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience and the diverse sectors, may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So overall, Nikola does remain as one of the more volatile titles in the market, and it would be a smart move to trade its short-term volatility instead of believing in its long-term potentials. For the time being, it seems like the market has priced in the dilution news, so we should expect some sort of recovery in a few weeks. For those looking for high-risk plays, buying Nikola and holding it for a few weeks might be a good start. Otherwise, it is always good to seek somewhere else for better opportunities for both investment and trading. So if you want to buy Nikola, I would recommend to commit a maximum capital of 0.5 to 1% of your portfolio, and would also recommend to split the allocation in batches of 20% at a time over the next 3 to 6 months so that you may purchase more in case it retraces even further.